Welcome to Gold Silver Pros.
Hey everybody, this is 𝘎𝙁𝙗𝙊𝙍 with 𝘎𝙁𝙍𝘍𝑅.com, and I have a very special first-time guest on the program today. It is Stephen Hochberg, who's a chief market analyst at Elliott Wave International. I'm going to give you a little bit about his bio, and then we're going to get into talking about the markets. Stephen Hochberg co-edits Elliott Wave International's Elliott Wave Financial Forecast with Peter Kendall, writes the short-term update thrice weekly, and provides commentary on the U.S. stock market, interest rates, and precious metals for a global market perspective. Over the years, Hochberg has become a sought-after lecturer and has been quoted in various media outlets, such as USA Today, the Los Angeles Times, the Washington Post, Barron's, Reuters, and Bloomberg. He has also discussed financial markets on CNBC, MSNBC, and Bloomberg Television. Hochberg began his professional career with Merrill Lynch and joined Elliott Wave International in 1994. Stephen, thank you for joining the program.
Well, thanks for having me. I appreciate it.
So one of the reasons we were interested in bringing you on, of course, we look at gold, silver markets, but you look at them from a different perspective. And we'll get into that in a few minutes in the interview. But really, you're using a lot of charting, technical analysis, probably along with some understanding of fundamentals to look at the market. You want to explain your view on the market a little bit overall before we get to talking about the different markets?
Yeah, well, the model that we use is called the Elliott Wave principle, the Elliott Wave model. And it basically is boiled down to this, that groups of people behave in a patterned way from pessimism to optimism and back. And the patterns that this movement from pessimism to optimism and back to pessimism, the patterns that trace out are actually measurable. And so if you can determine where you are within the development of one of these patterns, because we can't really see the future, but we can kind of have an understanding of the tenor of the times and what might occur. So if you can figure out where you are within the development of these patterns, it implies something about the future, and it allows us to make forecasts based on any freely traded market.
Okay, very interesting. And I'm very much about patterns. I tend to look long term, and the way that I look at them is almost from an historical perspective. So I do technical charting, but I'm looking at things like in the 80-year seasonal cycle, or looking at the 250-year super nation state cycle, those types of things. But I do look at shorter term trends as well. What do you think the benefits are to Elliott Wave analysis over other forms of analysis of the markets?
Well, it's endogenously regulated. That's a mouthful for me. But basically, the patterns are internally generated. So we're not so much concerned about maybe what the Fed might do or what earnings might do, because those tend to be results of social psychological forces that have already occurred. In other words, psychology and mood precedes action. So that when people are optimistic, they buy stocks, they start businesses, they listen to happy music, they wear, flowery colored clothes. And when people are pessimistic, they listen to dour music, they sell stocks, they contract businesses, grunge music becomes popular. So what we're looking for really is the psychology, and that psychology leads to actions, and it allows us to make these forecasts. So all the things that you talked about in the cycles that you look at, we do too, and in different ways, obviously. But the very fact that there are cyclical patterns means that there is a pattern to human emotion. So I think what we're talking about is very similar here.
So in terms of the pattern analysis, talk a little bit broadly about the markets before we get into commodities and gold and silver. What's your overall view on the markets right now? And I'm interested to see this because I think 2024 to me is going to be a very interesting year. As the Chinese say, may we live in interesting times. And I think certainly the news cycle has provided us with a lot of interest. What is your process telling you about the markets overall for this year? Do you look at a yearly basis, or what's your time frame?
Yeah, and the great thing about the Elliott Wave model is that it's a fractal. So it's self-similar patterns at different degrees of scale. So not only are we looking at short-term, but those short-term patterns are building blocks for longer-term patterns and even longer-term patterns than that. So in terms of Elliott, we're at what we call a grand super cycle top, meaning that it's just a long wave of rally that started. We can date it back to maybe the 1932 low. We can even go back to the early 1700s, depending upon the degree we're looking at. On a shorter term, from the 1974 low, from the 2008 low, all of these patterns are culminating right now together in what we think is going to be a pretty significant top in the stock market. So when you talk about transition, I think, yeah, 2024 is going to be an extremely interesting year, where we transition from, and I think we've already started it. For example, the Russell 2000 topped all the way back in November of 2021. So did the Dow Jones Transportation Average. So did the Value Line Composite, the mid caps, S&P mid caps. So we're in this process where one sector after another seems to be peeling away from the uptrend, and what we have left here is basically the Dow, the S&P, and 7 quote magnificent stocks that are lifting the market up. And I think when those stocks finally turn, I think the market's going to go into what we believe is going to be a pretty significant bear market.
So in talking about those 7 magnificent stocks, I've always thought that the way that the average person thinks, who doesn't spend a lot of time on this, and this is not putting shade on that opinion or in any way denigrating anybody that doesn't spend time in markets, and everybody has time to. We all have different things that we do. But for the average everyday person, they may look at 7 or 8 stocks that get quoted in the media and look at those and say, we have a healthy market. When do you suppose are those, what are the reasons why you have those 7 stocks that may be doing well when some of the rest of the market's not? For example, it looks like in tech, a lot of layoffs coming. Cisco just announced layoffs. But overall, there are a couple of leaders in tech. You've got, the usual suspects. You've got Microsoft and Apple. Why do you have certain companies that do well when the rest of the market may be fading just a bit and feeling, a little bit of that market pain?
Well, that's how market tops are made. As you rally, the market gets narrower and narrower until you only have a handful of issues lifting the market. I think I read yesterday, I think the top 10 market cap stocks account for 40% of all of the market rally this year. And that hasn't changed from like the top in 2000 at the end of the tech bubble. It really got down to Microsoft, Cisco, and a handful of others. Or you look back in the 1970s, you had the Nifty 50 back in the late 60s and early 70s, where people thought, well, if you just buy these 50 stocks and hold on to them forever, you'll never be in trouble. The market will go up and down, but these 50 stocks will keep you in good stead. Well, what happens in a bear market is that there's no place to hide. Everything goes down. And so while these 7 stocks or 10 stocks or how many you want to talk about are really the focal point of people's portfolios, and they're doing well as we speak, bear markets don't spare anything. And so once the market turns, these stocks, and remember, from 2021, from November into October of 2022, these were the stocks that actually were leading the decline. In other words, the market was down a lot because these magnificent 7 stocks were leading it to the downside. And then they bottomed in October 2022 and rallied and have been leading on the upside. So it works in both directions. And people kind of forget that when the direction is only one way, which is up. And they also forget it when the direction is down and think, oh my God, stocks will never bottom, will never have a rally. So again, this is psychology going from optimism to pessimism and back. And what we're trying to do is kind of pick out where we are in the pattern, because it implies something about the future and allows us maybe to get ahead of the next trend that's going to occur.
Pattern analysis to me is very important, and we've talked about fractals on our program as well. One of my followers, very smart individual, had a background in math, did a fractal analysis of the gold market, for example, and what that could look like in the next leg up. And I think that's very important. How do people look at the markets and determine, hey, this is not a long-term bull run. This may be a short-term rally before we get into a recession? Because there seems to be a euphoria stage a lot of times before you get into a recession, where things go really high. Maybe they're bubbled up. Real estate looks like it's bubbled up. The stock markets, to me, don't look reasonable. How do people differentiate between, that bubble or that last sort of euphoric phase and a regular bull market that we would expect to continue on for several years, and using stocks as an example? Right.
Well, unfortunately, they don't differentiate, which is the reason that they kind of get caught at tops, and get caught at bottoms. They're caught in stocks when they roll over, and they're caught in cash have they sold everything out when the market bottoms, when they actually should be selling stocks at the top and buying at the bottom? Very, very difficult to do. And that's where the Elliott Wave model helps us, because it's a specific pattern that lets us know kind of where we are. So how do people differentiate it? Well, it gets back to the model that you use. I think you got to use something that's going to give you an advantage. You're never going to be perfect. You can't know everything about the future, but you can be just a little bit ahead of the next person. And just that little amount is going to make you successful over the long term in the market. So you have to have a model, some system that allows you to kind of understand what's happening. And that's where the Elliott Wave principle comes in, because it's pattern based. So we're not concerned about the news of the day, because the news is just a result of psychological forces that have already occurred. And the news is reporting those forces. So if you can hone in on those forces, you can kind of have an idea of what's coming next. So that's where I come back to the model, studying it, just understanding it a little bit. You don't have to be a perfect technician to understand it, but it can really help you out and change the way you think about stocks and how to approach them.
So we talked a little bit about stocks. Let's shift over to bonds and real estate for just a moment. What are your views on those two markets? What are your Elliott Wave charts telling you about those for the next near term?
Yeah, well, we had a historic bull market in bonds from 1981 down into 2020. The 10-year yield on the U.S. Treasury note was essentially zero, historically low. And then we popped up to just about over 5%. I think that move from 0 to 5% was the initial wave, so to speak, of an even larger move up in interest rates. So since we've hit that 5%, which was in October, November of last year, rates have backed off. I think we're in the process of correcting part of that initial wave up from 0 to 5%. And there might be a little bit more on the downside in terms of rates coming down. Maybe the 10-year gets to 3%, maybe 3.5%. We'll be watching the waves to kind of see where it might bottom. But once that correction is over, I think we're in for another big upward move in interest rates, well above 5% as the 10-year goes higher and higher. And I think the reason that rates are going to go up is because I think people are going to get a little bit concerned about getting paid on their money and getting a return of their money. And I think when that happens, the reason is probably because the United States government, which has so much debt, we're $34 trillion in public debt, people are going to start getting a little bit scared of whether we can pay our obligations that we've accrued over all these years.
Do you apply your analysis also to an understanding of international stocks, or do you focus mainly on what is going on in the U.S.?
Yeah, well, we look at international stocks. We have a whole department that deals with the Asian markets, the European markets. My main concern here is the U.S. markets, but I'm looking at all the world markets, particularly in China. We do a lot of discussion in China, what's going on there. And it's all interrelated. So, yeah, we look at everything.
Okay. Well, let's move over to the commodities for a second. I think when you guys originally approached me, it was on the premise that it looks like commodities, or at least certain parts of the commodity sector, could be ready to have maybe a little bit of a bull market. Now, to precious metals investors' ears, that would be, you would be the Pied Piper. We'd all follow you, to the edge of the cliff, because it's been so dry there for so long, especially in the equity space. The mining stocks seem to be the most valued and the most underappreciated and hated, I guess, hated by the market, if you want to use that term, that they have been in a very, very long time. Do you see, Stephen, maybe a rebound in commodities or in the precious metals or any parts of that sector? And if so, what do you think that rebound would look like?
Yeah, well, we have to realize that commodities peaked out in 2008. Let's say the Bloomberg Commodity Index, just to give you an example of a commodity that we can track, declined 75% into 2000. So commodities have had a bear market relative to U.S. stocks. So if you're looking at a relative basis, you would have to say that commodities are much cheaper, quote unquote, in terms of already going through their bear market than U.S. stocks have. So on that sort of basis, yeah, I think commodities are something you might want to take a look at. I think they probably turned upward relative to stocks. And so even if stocks go down in a bear market, and even if commodities are hit in a bear market, which they tend to be, on a relative basis, they're going to hold up better, I think, than U.S. stocks. So I think going forward, you want to think about things. You want things that are safe and things that you can, that are tangible. And that a lot of that is commodities and gold and silver. Gold and silver, it's real money. Gold and silver are real money. They trade freely, just like other assets, and are moved by the whims of psychology. But I think psychology is getting behind the gold move here. Now, we've been in like this sideways range since about August of 2020. But I think while short term, there could be a little bit of a washout here in terms of the precious metals and a little bit more in the mining stocks, I think you're setting yourself up for, let's say, another year from now or 2 years from now. You're going to look back and say, wow, I mean, that was a pretty good opportunity to really get into the metals. And I think we're coming into maybe over the next several months after we bottom out, I think we're coming into a pretty strong upward move in gold and the mining stocks.
What do you think, Stephen, is driving that? And I'll ask this kind of in two parts. Maybe it's the same to you. It seems as though metals in particular tend to be counter-cyclical to other mainstream asset classes like stocks, bonds, real estate, what have you. Is that typical? Do you think this is different time for the metals, or you think this is a typical pattern? And what do you think that pattern could look like? Are we back into like a 2009 to 2011 cycle where we had new all-time highs in the metals? Or what's your feel for what that's going to look like this time?
Yeah, I think it is more of a 2009, 2011. I'm not sure it's so much counter-cyclical. If you remember back in the bear market of 2007 to 2009, there was a period in there where gold really got whacked. I think it was down 38% when stocks were going down in their strongest portion of the bear market. And I think the reason that happened basically is because people were looking for liquidity, and anything they could get their hands on to sell, to raise dollars, to raise liquidity, they just dumped it. And for a while, they dumped gold. But as stocks continued to go down, gold bottomed and then started rallying again. So I think you could be in a kind of a period where when stocks start going down heavily, maybe gold gets hit a little bit. But I think you're in this cycle that is much more bullish longer term for gold. And the reason for it is I think people are going to start seeking safety. They really haven't been looking for safety. They've been looking for speculation. And you can see this in the performance of the NASDAQ and the Magnificent Seven and stocks that they think are going to shoot higher. I mean, even some of these, meme stocks like GameStop had a big move the other day. So people still have that speculative mind, but in a bear market, that speculative mind goes away and people start looking for safety, look for safe assets. Well, you're not going to find that in Bitcoin, and you're not going to find that in equities, I don't think. But I think gold, it's real money. And when people look for safety, they look gold and silver and things that they believe, historically are going to hold their value over the long term.
Since you mentioned it, I'm not sure how much you cover it, but the crypto assets like Bitcoin, does Bitcoin take a little bit of the market away, especially for younger investors, from gold, silver? Or do you think that the world, my thesis is with the BIS regulation and introducing gold as a high quality liquid asset, and when I look at the CBDCs and the creation of them, digital dollar, digital yen, and maybe that next generation currency down the line, they're capitalizing a lot of the central banking system with gold. Gold's considered a high quality liquid asset. That was in Basel III. Do you think that the cryptocurrencies are going to take away from that? Or do you think that gold will always have its place as sort of the currency of last resort or the asset of last resort internationally, like it has for so many years?
Yeah, I do. And because what's so interesting about Bitcoin and cryptocurrencies may in fact be the future of our currencies in this world. I mean, we may be transitioning that, but but right now, Bitcoin is just a speculation. And one thing we've done is we've kind of overlaid Bitcoin on the stock market. And when the stock market goes up, Bitcoin goes up. And when the stock market goes down, Bitcoin goes down. And all it is pure speculation right now. There's no intrinsic value in Bitcoin. It's you're buying it, you're trying to sell it to someone else at a higher price. Whereas gold, you know, it's written in our Constitution. There's thousands of years of intrinsic value in gold and silver. And I'm not saying that is going to remain forever and forever, but in our lifetimes, I can't see Bitcoin or any other cryptocurrency taking the place of gold and silver as a long-term historical store of value.
Yeah, I think Bitcoin's around 14, 15 years-ish old, you know, 15, 16 maybe. And that's, you know, relatively speaking, the financial sector, it's not long. Now, you do have younger generations, and certainly, you know, I'm a Gen Xer, and I do have some certainly interested in it, but it seems to me it takes longer than that for something to really ingrain itself into the financial system, get the flows and get the money. We've seen Bitcoin, however, they've got some ETFs now. So it looks like Bitcoin's grown up a bit in terms of being part of the financial sector. Are there any thoughts from your perspective about how those ETFs could do? Is that something you guys are charting? Is that going to have a positive or negative effect on the crypto sector from your eyes?
Yeah, I mean, you bring up a great point here, but you know, if you think of cryptos, they were always kind of a way to remove yourself from the current financial system, right, where you couldn't be tracked and it wasn't controlled by the federal government, and all of those assets, all of those facets are very interesting to us, you know, because you know sometimes we don't want the federal government to control our money. We'd like to have free money, but the crypto ETFs are exactly the opposite. They brought Bitcoin back and tied it to the dollar. It used to be apart from the dollar, where you could buy Bitcoin and you didn't have to report it and so forth. But now, when you buy an ETF, you're buying it in dollars. So you're bringing Bitcoin back into the realm of controllable financial assets. I'm not sure that helps Bitcoin long term. It might. The problem with Bitcoin is that it's just so difficult to do transactions in it. And I have no doubt there'll be a cryptocurrency coming in the future where and we probably don't even know about it right now, where we'll be like whipping out a Visa card or a MasterCard, and you'll be able to do transactions like that. It will be outside the system. It won't be controlled by federal governments. That would be extremely attractive and probably take over in the future. But right now, Bitcoin just doesn't have that capabilities. And now with the ETFs, you're tying it back into the dollar and the financial system. So the very purpose of why it was originally formulated kind of gets mushed right there, okay, as a technical term.
Yeah, good technical term. I use that one a lot. My charts get mushed all the time. Yeah. So I wanted to leave open a couple of minutes for you just to talk about anything that we haven't talked about. A lot of the questions we talked about were sort of, you know, what you and I addressed, but I know that you cover a lot. Just a couple of free minutes there for you. What else are you tracking in the market? What looks interesting to you? What have we not talked about that you think is going to be interesting for 2024?
What I find interesting, most other people probably won't find interesting. And that is what we're telling our readers, our subscribers is seek safety. I think safety is underplayed right now. Safety is, you know, I think that's going to be the word as we go through 2024. You want to be in safe assets. You want to you don't want to be chasing these Magnificent Seven and chasing these indexes that are overvalued, historically overvalued in many aspects. So if we could say something to people watching, is that safety is boring. It's not exciting. But safety is going to really help you in 2024. And not only that, but in 2024, safety is actually paying you something. For example, the 6-month U.S. T-bill is yielding 5.25%. You couldn't say that a couple of years ago. So when we say, well, maybe you want to be safe right here, people were like, well, I'm not getting paid anything. But we are getting paid something for it right now. So if we could say one thing to people is be safe, be aware of what's going on financially. Short-term T-bills are paying great. 2-year floating rate notes that are issued by the U.S. Treasury have great interest, and you don't have to roll them over so often. And I think if you seek safety going forward, whether it's some in gold, some in T-bills, I think you're going to have a lot of money liquid and available, so that once stocks go through this period of decline that we think they're going to go through, you can walk in and pick them up for what cents on the dollar. And that's kind of where our view is going forward in 2024 in the next year or two.
Yeah, that does align a lot with my view as well. Go to safe assets. When you have times, and what we're seeing in the market, let me just back up a minute. What I predict for 2024 is a lot of choppiness, what I call a little bit of violence in the market. You're going to see the VIX probably go up a little bit more. You're going to see markets which have, a couple of 3% up and down days. I think in gold, a few weeks ago, we hit a fresh all-time high, and then the next day it went down like $130. So you're starting to see a little bit more choppiness. That seems to me sort of the market trying to figure out where to go. Is that your thought on that? Or is there a more technical way of looking at sort of that choppiness that you get when it looks as though whatever was currently doing well is not doing well, and you're sort of in that transition period?
Yeah. And I often see fractured markets are unhealthy markets. Because usually a rising tide lifts everything. And so when you start seeing these fracture, NASDAQ 100 at a new all-time high, NASDAQ composite still not above its November 2021 high, this fracture is not a healthy trend. And like you said, when in gold, now I could easily see gold maybe go down to 1800, 1810. But to me, that, if it did that, that would just be a tremendous opportunity, because I think the cycle for gold has turned. So if you get that washout, you get that weakness, I wouldn't be afraid. I wouldn't, I'd be more looking at it as an opportunity to position for another leg to the upside, another wave to the upside.
Okay. Another reason we wanted to bring you on is because you have a service, and we love services that help out our followers, things that help them navigate the landscape. And certainly Elliott Wave is a very well-established methodology. You guys do that at Elliott Wave International. So I'm just going to put a special offer we have for you up on the screen. You can get there by going to the link that I'm going to put up here on the banner. Talk a little bit about this, Stephen, and why people should get interested in your service and how it may help them in 2024, given all the things that we talked about, all the transitions and the additional risk, and maybe looking at things from a pattern analysis perspective and trying to find those safe spots to kind of live in while we go through this transition.
Right. So we follow this on a daily, minute-by-minute basis, and there's a couple things that we do. One is that we publish a monthly newsletter. It's called the Elliott Wave Financial Forecast that I write with my partner, Peter Kendall. And we also have another letter that Bob Prechter, who's been writing the Elliott Wave Theorist since 1978, publishes. And so what we've done is put together an offer. There's actually two different offers. One is you can get Bob Prechter's book, Last Chance to Conquer the Crash, for a discounted price, which is up on your screen. Or if you are interested at all in following the markets closely, whether it's stocks, bonds, commodities, the metals, you can subscribe to our newsletters, the Elliott Wave Theorist and the Elliott Wave Financial Forecast, and we'll throw in the book. We'll give you the book for free for doing that. And so we've got a special offer for people who are watching this. You can see the link there. It's elliottwave.com/GS Pros. And if you go there, you can either get Bob's book, Last Chance to Conquer the Crash, talking about the markets and how to be safe for a discounted price, or you can get the two newsletters and we'll throw in the book free of charge.
Fantastic. Great offer. Thank you so much for that, Stephen. Thank you so much for being on the program. I have to say that I love your analysis, and I'm very much a data head. I like looking at data and understanding patterns to try to get out ahead of things if at all possible, because we want to see as much in the future as we can, at least give ourselves some runway, especially during a transition period like this. I find it, Stephen, very hard, and you were talking about human behavior. It's very hard for people to turn on a dime, their behavior they've been the whole time, especially when popular media or popular opinion may be to stick with whatever has happened the last 20 years. So I appreciate your thoughts on there and your analysis, and know that you'll provide a lot of value to our listeners and viewers. So thank you so much for coming on the program.
Thanks for having me. It was fun.
Absolutely. Okay. Thank you very much for Stephen for coming on. We'll have more guests, interviews on the program as we continue through 2024. helping you navigate what looks like it's going to be interesting times. As I said, the Chinese say, may you live in interesting times, and I think we do. Thank you so much, Stephen. We'll have you on the program again.
Thanks.